What are you watching then in the markets as we weigh up the implications of a still very dire impact from the virus in a number of countries versus what broadly looks like a decent earnings picture at this stage?
Welcome. Thank you. We're looking at the market right now as potentially overbought. I think it's been a very strong first quarter. I mean, particularly for the first 2 months, we saw valuations, I think, becoming a little stretched, investor sentiment perhaps becoming a little euphoric. And at Credit Suisse, we've decided not to chase this rally. We've decided to neutralize, if you will, our equity and tactical asset allocation, because we think probably there's a likelihood of a correction in the coming months, potentially during the seasonal summer months. And I think it makes sense really to sit on the sidelines for the time being. The mutations and the virus that you speak about, of course, is a concern. But I think markets are more likely to take profit, to use this opportunity to lock in gains that I think they were very happy to take, particularly in January, February, and partial parts of March. And for that reason, I think it's more likely and a little more prudent, actually, just to turn market weight and wait and see how this volatility and the mutation, of course, is a catalyst, plays out.
OK, John, so you say there could be a correction coming. Where would that be most acute, do you think?
Well, I think in those sectors and potentially those markets where valuations are most stretched. And obviously, we are looking at key suspects in that particular space, and growth and US growth are obvious concerns. I think the problem with the market, there was so much good news priced in, there was so much optimism factored in. And when you do get these mutations coming through with the potential, obviously, to spread and for lockdowns once again to reimpose, as exactly we're seeing in Japan right now, the potential for disappointment is substantially higher. And I think in that context, it makes, as I say, a little more sense just to lock in those gains, move back to benchmark weights, and look to re-enter the market at a more appropriate time.
John, you do like Korea, South Korea and Thailand. Just give us the rationale for South Korea, given that the market there is up, what, 70% or so over the last 12 months. Do you buy the index, or do you have to be more discretionary when it comes to that market?
Well, I mean, the Korea story is focused very much on the underlying growth in developed markets and some emerging markets. And it's a key beneficiary, particularly of the surge in global trade that we're seeing. And you only need to look at its trade balance and indeed the trade balances of most North Asian economies to get a sense of how powerful that is. So we are seeing extraordinary earnings growth numbers coming from Korea this year, up to 60%. So clearly there's a huge momentum and positive story behind particularly the electronic sector, the export sector in general. And we believe that an overweight in this position is absolutely going to benefit client portfolios. Thailand is also a value play, although perhaps more tilted and directed towards the eventual reopening of broad tourism sector. Both, I think, valuations look pretty attractive. They're not as stretched as, for example, China equities are. And on that basis, we're happy to go overweight and are enjoying the benefits thereof.
And John, you talk about the virus concerns, of course. A few countries feeling the impact right now more significantly, arguably, than India, with a just terrifying run-up in cases there. How are you looking at India when the read-through of the virus is so much in focus? And what does it mean for the equity space there? Well,
caution. And I think prudence are the two watchwords for the Indian market. There's an extraordinary amount of value ready to be unlocked in India. But until, frankly, the virus situation normalizes, it's likely that the lockdowns will feed through to economic growth, which will feed through to corporate earnings, which will feed through ultimately to multiples. And multiples are high, by the way, in India on both an absolute and relative basis. So I would expect valuations to probably normalize and tick a little lower in the months ahead as this challenge, which I'm sure, by the way, they will overcome. But at least for the time being, I think it will weigh on markets. And for that reason, again, I think a cautious approach to the Indian equity space is probably the recommended one.
Okay, and you've talked about stretched valuations generally. What are the earnings out of China telling you about the justification for the valuations that we're seeing across some sectors here?
Well, earnings in China, frankly, are underperforming on a relative basis. I mean, they're positive, but they are being overwhelmed and dominated by earnings, for example, as I mentioned, in Korea or Taiwan. Again, North Asian powerhouses, very much focused towards the surge in global trade. The fact is China's economy is normalizing. That's another way of saying it's decelerating. I don't think the authorities in China are particularly enthused or motivated to provide substantially more stimulus than they did last year, for example. And on that basis, we are seeing a slowdown in corporate revenues, subsequently net earnings. So I think the China story was a little stretched. This very fierce rotation from growth into value, I think will likely continue. Possibly in the second half of the year, we might revisit the values, the tech story as valuations correct. But I think right now it's a value-driven story. Earnings are underwhelming, and from a regional tactical asset allocation perspective, there are better stories in the region right now.
Okay, John, I just wonder if one of those stories is climate change and the push there from China and the US. We have the climate summit coming up, being hosted by President Joe Biden. He's expected to redouble the commitments by the US to curb emissions there. Which assets do you think will be most affected by this climate push?
Well, the positive effect, of course, will be the solar, the wind, the EV. I mean, in fact, any sustainable segment which benefits from the extraordinary investment in the so-called New Green Deal. And by the way, that's not just the case in the United States, but it's also the case in Europe and particularly China. Let's not forget there's a commitment to carbon neutrality by 2060 by President Xi for China. So right around the world, we are seeing a multi-decadal investment thesis before our eyes. And with the amounts of stimulus and liquidity being directed into this space, I think there are very clear beneficiaries. I mean, on the negative side, obviously, the fossil fuel story needs to be watched closely alongside other negatively impacted ESG sectors. But for a general investment thesis, of course, we're looking at those sectors that will gain from it. And I've highlighted those which I think will absolutely benefit.